Okay, everybody. So here we go. We talked about how this week I am up in Boston getting ready to do the Naval Special Warfare Boston Frogman Swim. Swim is going to be tomorrow morning about 8:30 a.m. in Boston Harbor. And today is Saturday. It's about 2:30 in the afternoon, and I'm recording the show. Conan is not here with me, so you get me for the next however long it takes me to put out the info for the week. Okay. Weekly update show, 6 June 2021. So this week we're going to take a look at an analysis of a market top. We're going to take a look at what it takes basically to anticipate a top, what a top looks like while it's happening, and what the final lines in the sand are, sort of seeing or recognizing a top in the rearview mirror. The bonus chart is going to be Tesla. It's similar kind of to Grayscale, which was the Bitcoin trust that we looked at last week. I did a very similar kind of analysis with Tesla that I did with Grayscale last week. So I have both of those charts that we'll put up so you can see kind of the difference. And then we'll go through the daily TSP 6-month daily charts. Okay. So analysis of a market top. So when the most important first piece of this really is, when could we see a market top? It's always possible that the market tops out, for any number of reasons. But one way to sort of anticipate where we might see a top is to use Fibonacci extensions as opposed to Fibonacci retracements. And we're going to kind of look at both of those at the same time here. But Fibonacci extensions kind of give us an upside target in addition to Elliott waves. So we'll take a look at that. The lines in the sand, though, for me, are trend lines and moving average lines. So those are they're not forward looking as much because you have to wait for price to roll over to see whether or not you get support at the trend line or the moving average lines, where Fibonacci extensions are actually giving you a target to look at into the future. And sometimes you can see things on the daily charts that you can't see on the weekly charts, and vice versa. So we're going to look at a couple of different very well-known market tops and how they looked on a daily basis and how they looked on a weekly basis, and where the moving average and trend lines really came into play. Okay. So the first chart here is, okay, I didn't know if that was going to work. Good. So the first chart here is, we're starting at the top in 2007, right? And we had the big rundown where if you were in the market, you lost about 55% of the value if you were in the C fund. So what we do, since this was the last major low, was 2009, we use this Fibonacci retracement tool on stockcharts.com. And you start right here at the last known high, and you pull the tool down to the low, to the last known low. And these are the retracement levels. So if we started here, the retracement level will bring us all the way back to 0, right? So this is the 0 line. This is the 100. If we pull the tool down, it would basically, we started here and pulled it this way. If it retraced some amount, this line would be 50%. This line would be the 23.6, the 38%, the 50%, 61.8. Those are the retracement levels. The extension levels are where it would be above the 100% line. So it came down to here. Price retraced back to just about the 61.8% level, which is actually the most common retracement level. So retracement level, meaning it retraced, it gained back 61.8% of this loss. This is the most common area where it'll start to roll over. And it did. It only rolled over back down to the 38.2% retracement level, right? Now it found support there and then went higher. So once it got back above this high, what it's telling you is it's not going to keep going lower. because like we say, the Elliott wave stuff works in hindsight. So we had a big move down. We had a 61.8% almost retracement, and we're anticipating, if this is going to be a 1, 2, 3, right, which we didn't know at the time. You got a 1, a 2 to the 61.8% retracement level, and then once we got support here, that was really good news. And then right there, once we broke back above this high, that was a confirmation that we were actually going higher, and we were not going to, in fact, roll over into this. Okay, so that's how we would have used retracements back then. Extensions, the most common Fibonacci extension is 161.8, right? Which is the 1 over, or the 1 times of the 61.8% retracement level. So, and it's all in Fibonacci sequences. So the next one is 261.8. The one after that is 423.6. So what I'm looking at here is from the low in 2009, well, it was from the high in 2007 to the low in 2009. This is our reference distance. So the extension from here, the 1.618, price came up, took several years to get there, but once it got there, there was a lot of resistance at that price level. Once we finally poked up above that resistance level, now we were back in business, right? But we were definitely watching to see if we were going to go down here, because this is the most common retracement level. And you can kind of see it because we had a whole lot of resistance right there at that level. Okay. So this is, from the low in 2009, we pretty much we worked through all this resistance here from the beginning of 15 to, I don't know, close to about the middle of 16. So about 18 months worth of hitting this resistance level. And finally we broke out of it to the upside. So this is on a really long-term chart. The coronavirus correction right here took us back down to that 161.8 retracement level, right? So it acted as support at that point. And then we went higher. So the 2.618 times, which is 261.8%, was this line right here. We blew right through it. The next one is 423.6, which is about 45.40, 45.50 on the S&P 500. So it's possible that we still have some room to go higher on the S&P 500. We'll have to see how it plays out. That's in the long-term chart, with this as the reference. We still have some room to go higher, right? So I did this chart at the end of May. We had 8%, an 8% move higher from the May close would get us to that 423.6 extension. So this distance we have to move right here to get there is 8% higher. So the target, best case scenario, is 8% higher based on this 2007 to 2009 move. Okay. If we bring it in a little bit closer, now we're at the bottom of March 2020 from the coronavirus collapse, right? So we use the same Fibonacci tool, right, where this high is the 100% and the low in March is the 0. So you can see when we got back up here to 100, right, we regained 100% of the move that we had lost. We had a lot of churning in there, right? Market's trying to decide what to do. Once we finally broke to the upside, market kept moving higher until we get to 161.8. And we've been riding 161.8 since early April. Looks kind of similar to what we were doing back here, right? It's a different time frame, different time period, obviously. The Fibonacci, or the Elliott wave number count is a little bit different, but we're going to get to that in a second. But you can see what happens. The market has to work through resistance or support at these levels. And it's working through resistance right here at 161.8. And it's also working through resistance right here at 161.8, extension of the coronavirus move. Okay. The other thing you can kind of see on this chart, this flat, all right, we got from April to June. We got 2 months of flat. There's nowhere else in this chart that we're seeing a flat consolidation like that. It's just a little bit, it doesn't mean anything necessarily. It's just kind of a variation. And we're going to come back to this chart again without the Fibonacci numbers in a second. But this is kind of interesting because we've been going sideways, basically flat. We haven't gone below the 50-day moving average line, right? We still got support at the 50-day. So in the big scheme of things, market's still going up. It's just that until it gets, above this high, it's still suspect. Okay. So this is the top in 2000. Okay. It's a 3-year weekly chart. And so first we're going to look at this, and you can see the buildup, the actual top, and the rollover. And then we're going to look at what it looked like in real time if you were looking at a 1-year daily chart. All right, so this is a 3-year weekly chart. So you get the big run up. This is the 10-week moving average line. Price is hitting that 10-week moving average line and staying there. Breaks down. Now it's resistance here at that 10-week line. Comes down to the 50-week line. Right? Gets support there ultimately. Moves back higher. Okay, great. From this low in October 99, we can draw this trend line. It keeps hitting support there, right? So we have this as our line in the sand, that trend line. In addition to that trend line, we have a high, we keep getting higher highs. We have a high here, higher high, higher high, higher high, higher high, lower high, right? That's a problem. The first problem really was down here where we had a low and a little bit of a lower low, but now we had a serious lower low. That was really the first shot across the bow, was this part in here. But we had a high, and we get a lower high. No problem. We get a lower high. Now we're really looking at the 10-week moving the 50-week moving average line, the blue line, and this trend line. And so when price went below, this trend line had been in place for a year. When price dropped below both that year-long trend line and the 10-week moving average and the 50-week moving average. So all that happened right there. That was the last best time to sell. It's on a weekly chart. So it's not a daily chart, it's a weekly chart. It's much more significant. You got lower highs. It's a double top, but you got this high is obviously a little bit higher than that one. And you got this 1-year trend line and the 50-week moving average line, and they're all violated at the same time right there. You can't really confirm that the top was in place, but absolutely that was the time to sell. Market came down a little bit, came back up and tested that 50-day moving average line, and now it became resistance. It couldn't get above it. That was the last best time to sell, because from there, just completely collapsed. So you wouldn't really be able to identify this as the top, probably really until like right there. At that point, you could have looked back and said, okay, we've probably just seen a pretty significant top. You also get the technical indicators, they really topped out really back here. The technical indicators had been declining all the way from, they were leading the price. So sometimes weekly charts are much more valuable to look at than daily charts. Okay. So this is an after the fact chart, obviously. This is 1 year from September 99 to August 2000. So if we go back and look, September 99 to August 2000. So this is the time period we're looking at right here. If you look at it in real time, this was the top. This was the lower high, and we didn't know it at the time. But the 10-day moving average, the price is all over the 10-day moving average. It's even all over the 50-day. Like, it would have been really hard to track price here using the 10 and 50-day moving average because the volatility was just ridiculous. So what would you have done? If you look at this chart, what can you do? You can definitely see that if you draw that trend line on a daily basis, because this is a daily chart, anything below that trend line is going to be a problem. I mean, if you get a close down here, you definitely have a problem. And that's what we saw. That would have been it right there. So you take a whole lot of things into consideration when you're trying to identify a top. Okay. I think that's it for market tops. I'm sure we'll come back to it again in another episode, and it'll probably be much more interesting with Conan kicking questions back and forth to me, but for right now, that is what it is. Okay. Bonus chart is Tesla. So if you remember last week, the bonus chart was Grayscale Bitcoin Trust, right? So this is the chart from last week. We did the 1, 2, 3, 4, 5, right, of Elliott wave, and the ABC correction down to the 61.8% retracement level. And I was saying that's where I bought it, and I did buy it there. It hasn't done a whole lot since, so we're not gonna take a look at it this week. But you can see from this chart, you got the A, B, C that takes you down to that 61.8 retracement level. Here's Tesla. Same kind of Fibonacci setup. 1, 2, 3, 4, 5. Now we got A, B, and we are in the C. So what I think we're going to see is A, B, C. That's my plan A. That's what I'm expecting. But you can see that A came down to the 38.2% retracement level. B came back and retraced about half of this move, right? So if you cut this move in half, you would get to B. Now we come down and we have a double bottom as we speak, but I kind of think we're going to see a C leg down. Ordinarily, what you want is the C roughly corresponding to the low of the 4. And since that is roughly the 61.8% retracement level, it's very likely that that's what we're going to get. At least that's my plan A. If we got above the 50-day moving average line, if you own Tesla and it got back above that 50-day moving average line, before it got there, it would get above that high. So if it got above this high and above the 50-day moving average line, I would say that the bottom, the near-term bottom is in, and it goes higher from there. That would be my plan. That would be my plan B. My plan A is definitely Tesla keeps going down, at least to the 50% retracement level and possibly down to the 61.8 retracement level for C. Because that's very similar to what happened here on Grayscale. It came down, A came down to the 38.2%, just like A here came down, 38.2%. We had an A, B, C for B, and then an A, B, C for C. And so where we are right now, basically, is right there. Hopefully everybody can see that. Right there on Tesla is where we were right here on Grayscale back in the middle of May. So we will see if it plays out that way, but that's what I'm thinking. So again, we got a lot of support here. It's got to break through that support level, and if it does, it comes down at least to 50 and probably 61.8%, since that is just about the 4. And so that would be a good place to buy Tesla. If I was going to buy it, somewhere between 400 and 450. Okay. The TSP fund charts. C fund we know is $SPX, or the ETF is SPY. S fund $DWCPF. The ETF is VXF. I fund is EFA, is the ETF, and AGG for the F fund. AGG is the ETF. Okay. C fund 6 months daily. So it's interesting here because we are almost at a new all-time high. And the symmetry here is pretty interesting. We had a big run up, we got a flat, we got a fake out, and then a fake out on the downside. Came up, consolidated, came down. Now we're rounding just like this rounding was, and we had a Friday we popped up. So is it gonna roll over again and make the symmetry of this thing continue, which would give us a long-term rolling top? That's one possibility, that it's building a longer-term rolling top. I'm not 100% in that camp, but to be honest, yes, we're above the 50-day. Yes, we're above the 10-day, but the volume on Friday was less than Thursday. If you remember last week, we talked about distribution days and how Investors Business Daily uses that. Thursday was a distribution day because the price was down more than 0.2% on volume that was higher than the day before. That was Thursday. Then on Friday, we did a complete reversal, and we got a really good price move, right? Up 0.88%, but the volume was way lower than the previous day, and the previous day was a distribution. So it's not super encouraging. It's technically okay, but it's just all the pieces aren't there. And it didn't do it with a lot of conviction, right? We got barely any movement in terms of momentum. You got MACD's flat, flat as can be, and the stochastic is flat as can be. And then relative strength has barely budged on this big price move higher. So that, as compared to like down here, you have a significant crossover, right? What we want to see is crossovers that like mean something, right? You have a big price move off support and you want a big move higher. Big price move off support, it jumps. Price move off support and it jumps higher. We're not getting that. That's not what we're seeing right now. So I don't know if I'd be. Fortunately for us, we get to see what happens on Monday morning before we make any reallocation decisions. But right now, I am non-committal. S fund doesn't look any better. I mean, it had a decent move in terms of price, 0.75% move. It is getting support there at the 10-day and the 50-day. That's good. The MACD, I mean, it didn't do anything based on that move on Friday. And and the RSI barely ticked up a little bit on Friday. That was it. So not a very powerful move on the S fund. The I fund, we're still riding that 5-month trend line. So, and Friday, Friday's move was on less volume than Thursday, and Thursday, again, was a distribution day. Thursday was good because it hit the 10-day moving average and found support there. But Friday's big price move on low volume does not give me a lot of confidence in going forward. I still like the F fund in terms of charts the best. We had a big move down. We had a retracement rally, and then we were going sideways. Right, we're starting to look like an inverted head and shoulders, which is a head and shoulders bottoming pattern. And arguably, you could say that we just got the breakout from the neckline. We'll have to see what happens next week. AGG, the F fund, is very interest rate sensitive. And the strange thing is that this chart, especially with that breakout, is indicating that interest rates are not going up. When the price goes up, the rate goes down. So there's so many pieces to that moving puzzle. I can't get into it. But the fact that the price of the F fund is has broken out of that, what was it, 114.50 level neckline. It's really interesting. Again, it wasn't like this kind of breakout. We didn't cross, in a spectacular crossover like that. But maybe, if price continues, substantially higher next week, this will turn. It'll turn quite a bit. So we'll have to see. But in terms of the chart, this is still the best looking chart of all of them. The only problem with the F fund is that, this big price move was only 0.4%, and that was a huge move in terms of the chart. So, I mean, that would be something that if you saw that on the C fund, it'd be like a 2 or 3% move. We just don't have that kind of volatility on the F fund. Okay, I think that about wraps it up. We will post this on Sunday night along with the weekly update newsletter like we do every week. And in the meantime, I need to get in one more acclimation to the cold water before I do this 2-hour swim tomorrow. Okay, hope you guys enjoyed the sort of short version. And next weekend, we will be back in the podcast studio and life will be back to normal. All right. Hope everybody has a great weekend. Talk to you later. Cheers.